I'm Keith McCullough, and welcome to another Real Conversation. Real Conversations often provide an opportunity to educate. I often take a position in something, and we may get a lot of questions from you about what that position is in particular. And in some cases, the best way to explain that position is to get the people that have created the positions themselves. So it's my great opportunity here to get you, Danielle Gilbert, here to explain CLOs.
I'm thrilled to be here, Keith, and it's one of my favorite topics, so we're going to have a lot of fun.
I was saying, one guy pinged me, I'm really excited about this. I'm like, really, you're excited about CLOs?
I know,
now this is, it's not like, for those of you that like have the whole get rich, go YOLO, buy call options and Tesla idea, that's not what this is for. This is really, it's important to asset allocation, retirement accounts, getting away from the 60-40 type portfolio structures. So I want to get into all that, and full disclosure, I currently have an 11% total asset allocation to the two ETFs, CLOZ and CLOX, with CLOX being the bigger of the two, which many of you know. It's in Portfolio Solutions. These are not new positions per se, but they can grow into, that's a pretty big position. I think a lot of people would probably say anything that's double-digit percentage of your portfolio. So what's your conviction, Keith? And to me, it's not so much about conviction per se in terms of like the structure, but I think a lot of people need more, because I've spent time with you guys on
Yes,
this.
of course.
But I think a lot of people who haven't invested in this, because there haven't been a lot of opportunities to do so,
right?
Till you created these ETFs, they wouldn't know otherwise. So let's get into that, but let's just start maybe with the firm, the background, because some people might look it up and find Panagram, and now it's Eldridge.
Yep.
And I know you have a very good answer to that question.
I'm happy to give an overview. So by way of background, personal background, I actually grew up in structured credit. Launched my career right down the street here at the UBS trading floor, and I had a background. I'd studied engineering, and I said I wanted to do something really technical and interesting, and lo and behold, that was this very niche structured credit part of the market. Now we're standing here today, and it's really an evolution of that market growing to where it was, that it's in an ETF structure. Mm-hmm. Eldridge manages about $72 billion in assets. About $14 billion of that is in structured credit, and more than half of that is in CLOs. Wow. We love this asset class. The team has been investing in it since the beginning, and so it's a core hold in our own portfolio. So it was natural for us to launch and become a player. Mm-hmm. The team at Panagram, that was just a wholly owned subsidiary. Before Eldridge launched capital management to enable third-party assets, we had sub-teams that sat underneath Eldridge Capital Management. So that was essentially a team that had been part of the bigger part of Eldridge that we rolled down, and now we've consolidated the entire group so we can offer third-party products. Mm-hmm. So we launched CLOZ in January of 2023. We launched CLOX in July. We rebranded those this year in the Eldridge rebrand, and they've been incredible assets for not only because we invest in our own balance sheet, but to bring to everybody. Like, this is real true democratization. People talk about that all the time, but that often comes at a high cost and a high barrier. Mm-hmm. We saw that this was an opportunity to bring an asset class that we're experts in to really everybody.
Yeah, I mean, that's a really important point. When I was first introduced to CLOs, of course, it was in the darkness, right? Like,
yes, of course.
Into 2008, you wouldn't believe how much the Japanese own, or what,
Yeah.
But it was institutional product, not in an ETF. Not easily explained, particularly within like the lens of economic cycles.
Correct.
Which we have a solution for that. So again, newsflash, Quad 4 wouldn't be especially good for CLOZ relative to the other quads, but that's just an economic sensitivity. But now we have an opportunity to put it in our framework and, like you said, democratize it, put it in the hands of the people so they can get higher, safe, what I would call safe yields. Et cetera. Can you first, though, explain, like a lot of people may not even know what a CLO is?
Sure.
And I know she has some slides to help coach you through some of this stuff. I think it's pretty helpful.
I did. I brought a handful of slides because I thought, some of us are audio, some of us are visual, so I'm going to do my best to describe what is often, what I would say, misunderstood or misexplained.
Right.
But quite simply, if you see the chart that was pulled up, A CLO is really giving you access to senior secured loans, but with a buffer. So the pool, let's just use this example here. On the left side, I'm just defining what a senior secured loan is, which sits at the top of a corporate capital structure. These are to below investment grade companies that will have unsecured debt and then equity that sit beneath them. So think of a 40 to 50 LTV type of capital structure, but you're sitting at the top and that exposure has a claim on the assets. The pool that makes up a CLO is around 200 to 300 senior secured loans. So we're just going to talk about one CLO, which is about 500 million. 200 to 300 senior secured loans. These are small pieces to large companies. Chobani, Jane Street, Tory Burch. There's a name on here, Asurion. If you go and get an Apple product and you want to get insurance on your Apple product, or you're going to Verizon and you're getting your latest phone, they're the insurers. So these are companies that might be private companies that you don't know, but they're large. Average EBITDA could be like 800. So think of that cash flow. It's actively managed, small pieces, around 50 basis points. What is a loan doing? It's paying interest, and then ultimately it's going to pay principal. Those payments go into a waterfall. So if you think about the waterfall of those payments, the priority starts at the top and comes down to the bottom. So at the beginning, at the top of the waterfall is AAA. Those are bonds, they're floating rate bonds. So I can choose where I want to be in the spectrum. I can choose if I want first priority on those cash flows, or if I want a higher risk adjusted return. Maybe I get I earn more yield for taking that risk, but I can choose that. So at the AAA part, think of those bonds that makes up 65% of the capital structure. That's 3 months SOFR plus around 125 today. So if I'm a AAA investor, I sit at the top. In the history of the CLO market, there's never been a AAA default. Let's go to the bottom. There's CLO equity. It's actually shouldn't even be called equity. Because if you think about it, you're taking equity on a loan that still has debt and equity beneath it. I almost like to think of that as a non-dividend payer. It turns on and off based on what's happening in the cash flow, but it gets any excess flow. But the BB, BBB, which is where we really like to play, is the highest risk-adjusted portion of the capital structure. The BBBs right now are earning like 3 months SOFR plus maybe 275, and the BBs could be 550-ish range.
Can you tell people, I can guarantee you one thing, at least a small percentage of people don't even know what SOFR is.
Oh, yes, okay. So SOFR is it's very closely tied to the Fed funds. It used to be LIBOR, which is really a base rate of borrowing, and it's 3 month is a SOFR, so very short duration. These are not long duration assets, and right now it's 430 is what I checked this morning.
So the risk-free rate, essentially.
It's the risk-free rate, but it's not Fed funds. It's called something else. But basically, it's the cost of borrowing for 3 months.
Yep. Cool. All right. Didn't mean to.
No, it's okay. Stop me, please, and make sure that I'm not going down too much of the CLO nerd path.
Well,
I want to stay.
The only thing in financials are the bloody acronyms.
Yes,
right?
I know why. Right.
My partner Josh Steiner, who runs he runs macro with me, but he's our financials guru. I'm like, Steiner, what's this one?
Yes, please.
And during every cycle, it seems like there are more of them. But
exactly.
But thank you for that. Keep going.
No problem.
So we have the waterfall. We have the setup.
So we have the waterfall, we have the setup. It's important to understand the players. So there are obviously the investors that invest in the debt. There are the equity investors. And then there's the CLO managers who are actively managing the pool of loans. Mm-hmm. All are really are great participants. I like to kind of think of a CLO as a bank. It's a bank with one business line to lend to businesses, lend small pieces to businesses. But guess what? It's a better bank. Mm-hmm. Because how are most banks funded today?
With deposits.
Short-term deposits.
Yeah.
Guess what this bank is funded with? Term financing, 13-year term financing. Mm-hmm. So when a CLO is created on day one, there's a 2-year non-call period where the equity holders cannot call. There's a 5-year reinvestment period where there's that optimization of the CLO, the tending of the pool and optimizing it. And then after the 5-year mark, you start paying down your debt. So you start paying down your AAA debt first and kind of going down. Now, most CLOs don't last for the whole entire 12 to 13-year term because as you're paying down the AAA debt, your cost of financing.
Yep.
That pool goes up. So then the CLO equity will come together with the manager and say, okay, are we going to call this deal and pay back our debt holders? Are we going to start the clock over and refi? Or are we going to reset where you get new terms, but you're really kind of taking? So it depends on the market dynamics of what direction it's going to go in. But I think it's very important to understand that, because this pool is funded as a better source of financing for these companies where you're really just getting exposure to small, tiny pieces.
Mm-hmm. I bet when you're at RBC, you couldn't tell them this was better than their bank. You know?
No, you probably couldn't.
It's great though, I like it. And the difference between, people may have heard of CDOs, CLOs versus CDOs.
Well, you talked about acronyms. And I really think...
I can tell you what this one is.
This one's like the evil cousin, because it has a very similar name, but a very different outcome.
Yes.
And it should be explained. And I like to actually, sometimes I lead with it before I even describe what a CLO is. I tell people it is not a CDO. But here's the evidence. This is Moody's color from basically when the CLO market, CDO market was first created, early 2000s through the GFC until 2022. And these are cumulative default impairments. And what are the differences? I mean, it really does start with the collateral. So the collateral in a CLO, the L, the loans, are senior secured loans to large companies, small pieces. A CDO, it was mostly subprime, single concentration risk to a borrower, to the consumer that was really stretched. Those pools, this is important, were static, where CLOs are actively managed. So and the diversity. There was really no diversity. It was housing. It was to a certain subset of a borrower. Where CLOs, there's so much industry diversification. It's actually, there's rules within the structure where you can't take single concentration bets on a name. An industry is mostly maxed out at 15%. And the performance, we can just see it visually on the screen. So I feel like CLOs should probably be renamed. We should come up with a new acronym, because then I won't have to even show this slide anymore.
Well, people could go in their ChatGPT and say, how many people blew up in CDOs during the housing crisis?
Yes.
I mean, you can definitely get some, like you said, it's like just bad, just sounds bad if you remember how bad that was.
Right. I mean, they made a whole movie about it. So The Big Short.
Yeah, exactly. But this is, like I often just kind of think it through as, okay, it's not that, therefore we're just not going to talk about that. We're going to go on to what it actually is, right? But it does require a little bit of explanation. Nobody would explain that unless you did. So you have that. I mean, how big is this? Is back to the CLOs and the opportunities in CLOs? How big is that market total?
It's a $1.3 trillion market.
Gargantuan.
So yeah, put that into context. When I started my career, it was probably 20 billion. Since 2018, I think it's more than doubled.
Yeah.
Now, why is that? It's a derivative of what the loan market has done, which has grown exponentially, especially post-GFC. You just see it going straight up. And the CLO market is the majority buyer of those loans.
Right. So if you're one of the issuers, you're sitting there like, I know where to go.
Yes.
I don't have to go to my, where would they, they would go to the bank, right?
So these are syndicated loans. So the bank is going to take, and this is a very active market. There's probably loans in the market today, but these are syndicated through the major banks, Morgan Stanley, JP Morgan. Right. The banks hold not only a role in syndicating these loans, so originate to distribute model, but the banks are the largest holders of CLOs. Mm-hmm. So your largest banks actually probably hold the majority of AAA CLOs because it's great risk that they can hold on their balance sheet.
Right.
Remember, it's another form of lending, but they get great capital treatment for it.
Mm-hmm.
And with the whole Basel III endgame, they're saying that the capital treatment is going to improve even more. Japanese banks obviously own, but it's held by mostly institutionals.
Mm-hmm. Okay. And what role does the collateral play in the structure of these things?
We should spend some time on the loan. So I have a couple of slides actually that we can walk through. So the L in CLO, I think I've probably already said it a few times, there's senior secured loans. This is just total return over a long time frame, where you can see, of course, during the GFC, loans sold off. But But it's generally, because it's a part of the capital structure where it's senior, you're mostly going to have a total return that's in the probably 6%-ish type of range. But I like to show this because, again, it's evident of collateral that's been positive for over 20 plus years. Now, the next slide is really what we're always closely tracking, which is the default rate and the recovery on those loans. Mm-hmm. So right now, the index default rate is less than 1%, and the recovery, the long-term historical recovery on loans, is in the 64% range. That is changing a little bit. The index default, there's this new concept that's coming into the market called LME, liability management exercises, which is where the lenders will come together and there'll be a group that is really negotiating what would be a higher recovery or a lower recovery, whether you're in and out of the group, to avoid bankruptcy. Like, at the end of the day, people do want to keep defaults low, and so if there's another outcome that maybe the recovery is dragged down a little bit, but you don't have to go and you can keep it out of the courts, that is a new trend that is happening.
Yep.
How that impacts CLOs, we haven't seen any massive impact. What I would say is it's just increased diversity. Mm-hmm. So people used to, 2 years ago, 11% of the CLO portfolio would have their positions be 75 basis points or higher. Now that's reduced to maybe 7%. Mm-hmm. So they just want to, so again, it's just increasing the diversity so people don't have single concentration bets.
It's epic diversification, though, even to begin with, like, versus where it came from.
Yes.
Comparatively speaking to like what people actually own.
Oh my
gosh.
gosh.
What Americans own in their retirement account, like 60-40 on the 60
cent? Yeah, they have
cent?
it's like 7 names that you're concentrating. And by the way, that's equity.
Yeah.
Like, I'd rather be lending to small pieces and have very diverse exposure.
Yeah.
Especially in the current
And once you
environment.
go, like you're citing like S&P 500, 7 names is 30% of the index, 40% of the volatility. But if you go into sectors, which this is a sector of credit.
Yes.
That's how we would put it on the board. Like sector ETFs have even more on the equity side concentration. Right. XLK, for example, tech, there are 3 stocks or 50% of the XLK. That's anti-diversification.
You're taking a lot of bets.
Right, so in this case, where people actually, the number one concern most people would have in any credit investment that isn't really well understood is defaults and actually bad things happening. Right, like, I mean, really bad things can happen in equities called drawdowns and crashes, but like in this case, I think people would be pretty surprised at how low defaults even were coming in and out of the pandemic. I mean, it's because we had a very short contraction and a lot of stimulus, but to me, that's actually quite, I wouldn't say comforting. That's not the right risk management word, but
no, I mean, I think, of course, there's always risk. This is credit. But the other thing that we didn't even talk about is there's no interest rate duration risk either here.
Right.
So you do have to worry about credit spreads kind of blowing out in different times, but at the end of the day, it's not to one industry, it's very diverse, and you're sitting at the senior part of the capital structure.
Yeah, and that's exactly how, like you explained it to me and how it moved. We had a credit, I wouldn't call it an event, a credit scare in April.
Yep.
And that's how CLOZ, for example, moved, albeit on on a very small, in order of magnitude to the equities people were dealing with and all that risk.
Exactly.
But it did move. Like, it's going to move when the perception of a recession's rising, credit spreads are widening. When we were 380 over on high yield OAS, that was probably the low for CLOZ for the year. Mm-hmm. So there is that. Like, so for people that are part of our community, they should understand that there is credit sensitivity on, like, it doesn't move or it moves, and if it moves, it's because there's some type of a credit event, whether it is to be a perceived risk or an actual risk that plays out.
Yeah, I think it's important, and listen, that's why you can choose, like, CLOX is a AAA exposure, CLOZ is a BBB exposure. Obviously, there's going to be more sensitivity, but you're going to earn more income. Yep. So it's like, what's that trade-off? I have some investors that they might replace, like, their loan ETF exposure because they don't have the buffer that you get within a CLO.
Right.
And they'll barbell between the two. And then they'll adjust based on their views of credit spread. So it's really, we're giving investors choice of kind of how they want to express it.
Now, on the performance of the actual loans themselves, how do those, like, compare?
So we're going to go. So I talked about default and recoveries, which are important. But these next couple slides, what we've done is we wanted to look back and we wanted to see how are loans performing within the CLO structure
Exactly.
versus the index. So if you look at the GFC where there's that big spike, you can see that loans actually within the index spiked to almost 11% in defaults, but within CLOs it was around 5.5%.
Yeah.
And then you look at the other spikes. It's more pronounced when we're in less benign environments. They're kind of on top of each other when we aren't. But the reason of that is obviously the rules, but also the active management. I mean, these are tended to, but there's a lot of guardrails on what the managers can actually do, but they can actively manage and they can position the portfolio for really that outperformance. Because at the end of the day, you mentioned this too, Keith, this is a credit instrument, so it's all about managing to the downside.
Yeah.
And just protecting that income stream. That's really what everybody's trying to do here. That's why we like the asset class, but it's really about managing to the downside and protecting the income stream.
I mean, it's a tough one for people to wrap their heads around. I hate the average of things because it's always the particular thing, the particular cycle
Right.
that blew you up.
Yes.
Like '08, like that's an albatross. It's a hard one,
It's horrible, yeah.
To compare against. But these cyclical slowdowns that actually didn't even manifest into recessions.
Yes.
That's where you see that's where you guys can see the bumps on the chart. 2014 to 2015 was not a recession.
Correct.
It was an entire blow up of the energy complex
the
by
commodities.
2016,
Yeah.
right? But there was a recession, there was credit risk there.
Even COVID.
Yep. So maybe actually let's use that one. Let's like the 2015, which was a subtle one, not so subtle if you're on the wrong side of it. But if you were to look at the portfolio today and you took out a sector exposure like energy, would that be of consequential weight?
Well, remember that the weight is maxed out at 15%.
Per sector?
Per sector.
Okay.
But I would say after that 15, 16,
Got de-risked.
it's been de-risked. So if you look we'll have a pie chart on like what the exposure is of the energy sector, it's going to be a lot smaller.
Yeah, in that period,
So-
we had some equity shorts that we, sell calls that we had,
Yeah.
where there are frauds, stocks went to zero.
Yeah.
There's a lot that can happen in there,
There's a lot that can happen, but
but it doesn't impact the index that much.
It does. The thing with CLOs is, remember when I started at the beginning, this is term financing. There's no forced sale event. It's really just redirecting cash flows.
Yes.
So if there's a real
Good point.
issue, what happens is the equity just gets turned off. And those cash flows get redirected to the senior part of the capital structure. And so that's your okay, something's happening here. And then it could get turned back on as well.
Yep.
So that's the risk that you're taking as an equity investor, is to kind of be in that part of the capital structure. But there's no forced sale.
Right.
So I think that's important.
Well, as a go anywhere investor who can go long and short, which many of our subscribers and clients do as well, and that's certainly how I do it. If you see a quad 4 coming, you just go short a basket of small to mid cap levered energy stocks. If you're back in that period of time.
Exactly.
Or Hedgeye's favorite shorts in that sector.
Yeah.
There is a way to actually make money even if the thing is not going up anymore.
Yeah, you just don't want to do it with your credit.
Right.
Right? You want your credit to just earn income.
Yeah, it can earn its income,
can
and you
earn
can
its
actually
income.
get bigger in it.
Yeah.
If you understand how to
like
structure
what you
it.
guys did positioning just a few months ago, how you positioned into X.
Yep.
Which was really like the capital preservation play that you talk about in the quad 4.
Right.
That was a great positioning, because that's how we see it. CLOZ is also can be a strategic hold in a portfolio. It has income. You just have to be prepared to take that volatility hit when market spreads blow out. But we have, most of our capital, is what I would say is some of it is institutional capital that sits in these ETFs. They understand that, so they're just going to kind of sit along and manage through those.
Yeah, what we find is that a lot of family offices in particular, they had to make a lot of money to have a family office.
Yes.
They understand businesses, they understand risk management. They're not dogmatically imagine that linked to some 60-40 portfolio for life.
No, yeah.
Please. But they'll really get into this, and they'll be like, oh, okay, I could see where, and it's all about where you fit.
Right.
Because you're part of a portfolio, you're not the thing.
Right.
You're the thing for the dude on Reddit. These aren't.
Look at the 60-40 in 2022. Everything,
it's terrible.
Increased correlation. If people didn't learn from even that recent event, I don't know what they're doing.
Well, I mean, even today, I mean, you can have a heart attack every morning, being hostage to rate sensitivity.
Yes.
Or you can have something that doesn't move, that just pays your coupon every, like these two ETFs do.
Exactly.
So there's a big difference, and we'll get into the difference on those yields in particular. But what levels of defaults?
Oh, let me keep going with this. All right. So we showed the slide where I was talking about defaults within.
Is that the next?
The index, and then defaults within CLOs. This looks complicated. It's not. It's basically like, how high do loan defaults need to be before I lose $1 principal? That's what this chart is showing. So what we did is we took that light blue line in the prior slide, which is the defaults within CLOs, and then we ran it. It was actually a bank that ran the analysis, but they ran the analysis on all CLOs that were outstanding, and with a recovery of 50 cents, so not the recovery of 64 cents. And the threshold was around 5% loan defaults for the BB and around 41% defaults for the AAA. Now let's just talk about the BB really quick. That means that for the life of the CLO, it doesn't mean that you hit 5% and you're blown out. It means that for the life of the CLO, you have to be consistently at 5% on senior secured loan defaults to really take that $1 principal hit. Obviously, at the AAA part, there's never in the history of a CLO market had a AAA. It's very difficult for loans to kind of get. We can't say that it can never get there. We're just looking at historical numbers here. But this gives you the appreciation of like how bad things really need to do for these structures to start dislocating. Mm-hmm. And the next slide, so now we're shifting out of loan default land and we're actually going to the actual CLO defaults.
Well, because this is what people would understand. They get what a corporate default is, but they don't know the difference between that and a CLO default.
Exactly. And this is what people always ask. So this is kind of the build-up, because you need to understand the collateral before you understand what the actual CLO defaults are. But this is the data. This is S&P. This is every CLO that S&P has ever rated. Pre-GFC, which is the 1.0, and post-GFC, which is a 2.0. I didn't make up that terminology. It does exist, 1.0, 2.0. The changes where the structures improved. Mm-hmm. So after the GFC, you just saw more standardization. And really what that led to is an accelerated growth of the asset class. But if we just look at the numbers, pre-GFC BBs, the cumulative, these are cumulative default numbers. The cumulative default for a CLO 1.0 BB was around 3.89%, or just rounded up to 4%. Post GFC, it's 52 basis points.
That's crazy low.
Everything above, everything investment grade, there's been 0 CLO defaults since the GFC. But what we like to do is we like to stack those cumulative default numbers versus US corporates. Mm-hmm. And then compare the corporate rated equivalent. So we use a 13-year time frame, which is what the 1.0, obviously we're now at 15 years for 2.0. But let's just do the stack comparison. That BB that I talked about, which was around 4%, it's 15% for corporate rated equivalent. Starkly different risk profile that you're taking. And obviously as you further go up the capital structure, it's even more dramatic.
That's really good. Hey, now you can see why the Japanese wanted these instead.
Yes, and they still keep buying. Just last week I saw another Japanese company. It's like we're looking to go long AAA, AA, single A. So, I mean, institutions love this product. They continue to invest in it. And what's great about the ETFs is now, the individual investor can get access. Mm-hmm.
That's great. And actually, the next chart you show exposure to CLO debt versus corporate credit. I don't think we went through that, did we?
Oh, this is just kind of to summarize it. Like, why do we like being exposed to corporate debt in a CLO structure, maybe versus a more traditional investment grade bonds, or even high yield if you're investing, or leverage loans directly? Is you're getting more yield. There's a better historical default track record. And then right now, it's just less correlated. Mm-hmm. I mean, a lot of people are in 60-40 portfolios or a version of that, and CLOs are not in the ag. They are in some core bond plus portfolios, but it's really about how do I dampen that volatility, and really how do I protect that income, and that this is a great asset class for that.
What is the biggest exposure you've seen to CLOs in a pie chart from a pension fund? Like,
Well, I mean, some of the largest pension funds have massive exposure because they're buying. It depends on what part of the capital structure. It's hard to see, it's hard to actually identify because it depends on how they categorize it.
Right.
So they might put it in the liquid credit bucket, they might put it in the private credit bucket, because even though these are broadly syndicated loans, the underlying companies are often can be private.
Yep.
It's a mix of private and public. But I would say that most of the larger pension funds that you're aware of are going to have some version of CLO exposure.
Now, when I look at the pie charts that I see, which, you know, like a lot of family offices, they use, you know, the beauty of the market, the manifestation of ETFs, and you have an ETF for anything.
Yes.
That's a problem in many cases, too.
Well, I think it goes back to the liquidity. So let's just talk about liquidity here, because that's what a lot of people would say, oh, is this market's not liquid? It's very liquid. There's been north of 40 billion that's just traded this year of CLOs. We talked about the size of the market being 1.3 trillion, 200 billion, you know, that's just come in as far as like issuance this year. This market trades T+1 settlement. It's QSIPed. It's very actively traded. So when there is any, like, you need to have that much liquidity, I think, to still fit into the CLO ETF wrapper. There are some entrants that are coming in to do private credit. There's private credit CLOs, which also trade T+1 settle. But the market is developing now for the liquidity of private credit, where you probably will see this evolution of like more players coming in. But right now, our ETFs, your exposure is to broadly syndicated loans and the most liquid part of the CLO market. Even the managers that we pick, there's different tiering of managers that have different liquidity profiles. We want to align with the most liquid managers. So it's tier 1 managers. It's going to be the biggest names that you'd be familiar with when you're looking at the underlying. And that's very important, because when it comes back to it, like the wrapper, the ETF wrapper is great because it gives access, but you need to have liquidity.
Yep.
So.
Well, I mean, people over time have gotten comfortable with that, with JNK, HYG. If I just move up this,
Exactly.
you know, up the curve, LQD. These are some of the more wide. Like, I'll see those in a lot of family office pie charts. I'll come into the meeting and they'll push it across the table and say, "This is where we're at. What do you think?"
Right.
I'm like, "Whoa!" Let's like.
Let's
sometimes
figure out how to diversify.
Sometimes, yeah. That's generally the first observation.
Yeah.
But the second, third, and fourth observations is that they won't have Bitcoin, they won't have CLO exposure, they won't have a bunch of things that I have, right? So that's what I really want to talk about, because I'm not trying to sell them an ETF, I'm trying to sell them the process, which is like, how do you actually create like some real diversification across asset classes? Is there asymmetry in your portfolio? And so when, like, the main question for you guys would always be, like, if I had you sitting over here and I had HYG, Team HYG sitting over there, it would be like, well, who deserves the incremental capital? You know, and why would one choose? Like, why would you say, why would somebody pick? I think you wouldn't go CLOX on that. You'd go CLOZ against HYG.
You would do CLOZ versus HYG, and I think it comes down to your views on the exposure. Okay, let's just talk about the exposure. It might be the same company,
right?
But guess what? I'm senior to you.
Yeah.
I'm senior secured, and you know what else I have on you? This is where it really is the rub, is your view on rates, right? So right now, I'm taking advantage of the fact that the front end of the curve is elevated, and I don't have to, I can move with rates. If you're convinced that rates are going down tomorrow, which right now it's projected the second half of the year, there's maybe 2 drops, and you think that, like, I'm gonna take that bet and I wanna capture that income today, and I'll take that duration bet, then you should go in HYG. I think there's actually probably a complement to both in the portfolio. It's not really one versus the other. What we like about CLOs is we think about it less tactically. We think about it as a strategic hold, because we can take that interest rate duration risk off the table. And remember, there's credit risk, which is a spread that you're earning off of that double B, which could be 500 to 600. That's not all credit risk. We already talked about what, you know, what was Evans. A lot of that's just complexity premiums. You're literally paid to invest in something that's called CLO, because the market hasn't really officially caught on to it.
Yeah. I mean, it's especially for people that haven't really thought it through.
Right.
I mean, like, when you talk to them about, I talk to them about fixed income ETFs all the time. And it's like, okay, you got that there's rate risk and there's credit risk.
Yes.
Right? To be able to take out the rate risk, I mean, takes out essentially all the risk that one would be considering in HYG. You mean, when
And that's what you're doing. You're taking out the rate risk.
So that's a big deal, and there should be a place in a portfolio for that.
Well, think about the regional bank crisis.
Right.
The large banks were sit on a lot of CLO, AAA exposure. Those regional banks were sitting on long-term treasuries. Where was it? It was a rate. It was the fact that they were in long-term. They had short-term deposits. People came in. There was a run on the bank. It was obviously easier to have a run on the bank, and they were mismatched on their assets and their liabilities. If those banks had owned AAA CLOs, they would probably be around today. Because again, when you're investing in any kind of credit instrument, I remember when I went on the UBS trading floor, which is where I started. You have to rotate and kind of find your home. And I remember I sat with this guy one day, and he said he was basically challenging everybody, and he said, "What are the risks? Like, this is a bond, but what are the risks?" And he wanted you to think of it in multidimensional risk. He didn't want everybody to come in. I knew it was a challenge. Like, I kind of heard a little bit about it because you have your friends. But I think that's important.
Because you have your friends.
Is that you need to be prepared to understand that these products are supposed to have a purpose in a portfolio, and they do all have risks. Inherently, these are credit products. But what's great about the CLO product is you can take that interest rate risk off the table.
Yeah. Well, I mean, and then when people look at the yield, I mean, there's the competition's manifest. Because for years, people have been allocating, even on the equity side, you go to Seeking Alpha, and there's whole sections on look at this real estate investment trust with this yield. No research required, no credit reports, no nothing. They just chase the yield. But can you just explain what the yield is on CLOZ, just so that you understand what we're talking about?
Right now, I mean, I looked at it because I needed to make sure my numbers are right before I walked into this meeting, but net yield right now is north of 8%.
Exactly.
And that's delivered to the investor monthly. And it's, the product can spike, obviously. Those yields can go up when credit spreads blow out, but that's the range that we're kind of used to seeing. So it's been an incredible product. And then CLOX, which is, you have $7 trillion sitting in money markets today. This is a product that is Fed funds, which is really 3 months SOFR, but a derivative of Fed funds, plus a credit spread. So that's earning a 5.5%. But it's AAA rated. Your risk is AAA rated risk. So I think you have to think of these products as two different versions of how they fit into the portfolio.
Yep.
Because the risk profile is different, but they're both earning really nice income.
Yeah, I think of CLOX as that it competes with my cash.
Yes.
Like whatever cash component, I could be talking about an ETF like Bucks, BUXX, which everyone knows that I have in there, or FDRXX, my Fidelity, high yielding cash.
Yeah.
They pay a good rate. And CLOX, that's their competitive. I always think of it like competing for my capital, right?
Yeah,
I think that this is what you should do. Make the damn thing earn your respect and your returns, or your capital, so that you can generate returns. And that to me is every day. It's why not? It's you could be a lot piggier, because a lot of people, the $7 trillion, to your point, is sitting there saying, I want no risk at all.
Right.
Right. What kind of discussions do you have on that? How does one delineate between 100 basis points? I mean, I can obviously see the math on that.
Well, we actually have a chart here on the cumulative returns over, which just shows the power of compounding. But I do
compounding interest.
Compounding interest, it works.
I love it.
I don't know if we have it in here, but basically it's a bar chart that compares treasuries, the ag, and CLO, AAAs, CLO, triple Bs, and double Bs. And it's staggering the difference between just if you had your money sit from 2014 to 2024. I think the numbers, and correct me if I'm wrong, but for double Bs, it's 157%. For triple Bs, it's 84%. And for AAAs, it's around 40%. But let's just say I put my money in treasuries or even the ag. The cumulative over the past 10 years was 8%, 14%. So that income matters.
Big time.
It really matters. And then we have the annualized, which is sitting there where double Bs are annualized are around 9%, and triple Bs.
And for a long time, I mean, it's an interesting time for these types of conversations, because forever, in fact, for most of our career. Like, I'm not going to date myself, I do that long enough, but I mean, I've been doing this for a quarter century.
Yep.
And for 20% of the time or less, has there been a decision to make there because the rate was zero?
I know.
Right? I've never really been able to teach my kids, I have 4 of them, you know, the power of compounding interest, the power of a risk-free rate and compounding interest. The competition that is for your spy monkey, for your favorite stocks. You know, like all this was born out of something which is called ZERP. Right? So we're finally at a point where if you could, you would. I think most investors, if they've studied it past their nose, would say, like, look, what if I've worked my ass off my whole life to get to my retirement account, let's say I've worked for 20, 30 years, you know, would I take 4, 5, 6% a year every year without any downside?
I mean,
yeah, you would.
Yeah, you would.
Or you should.
I know.
Or you should consider how to make it look a little bit more like that and less like 60-40 looks like right now.
Well, it is interesting. I was actually explaining this to my teenage son, and he said, so Mom, that's kind of just passive income. You know, when I was talking about the CLOs. I said,
how old is he?
14.
That's pretty good.
And I was saying,
he's been listening to Mom.
I said, you know, think about it. I'm just a lender. You know, when you buy this ETF, you're a lender. And you're lending to large companies. Some of them are multinational, some of them are US, very diverse. And I'm just earning income. And so, but that, again, just making it really simple for people to understand, I think is important because the terminology and then this history of this asset class being conflated with CDOs and the fact that it's really mostly been held by institutions.
Right.
Like it's a $1.3 trillion asset class, but only 30 billion of that sits in the ETFs, in the liquid.
That to me is one of the craziest things you guys called out. I was trying to wrap my head around because I'm getting into the ETF business, and like the magic is, it's just like anything in asset management. The art of asset management is having assets to manage, and you know, getting to certain thresholds begets higher thresholds of AUM. But the market typically isn't that big standing behind you, right?
That could be the gating issue. In this instance, it's not. Right?
No, it's
the room to run is vast, and I think what's great is the asset class just continues to be resilient. Right. So it continues to be tested and challenged, and what happens is it stands up, and then people keep pouring money into it. So it's a great opportunity, but I love educating on it because I can put up those charts and evidence to people about the risk profile and what they're really getting, and we think is amazing high risk adjusted returns. You get to choose though. You can choose if you want to be the AAA or the BBB.
And the best education you typically get, I mean, so let's park that CLO X versus my cash.
Yeah.
That's the competition for me.
Yeah.
And again, I'm just explaining how it works for me. Sometimes that helps people. But if I start really taking, like, there are over 3,000 ETFs in our process, in our system that we rinse through, repeat every night, and I'll get a constellation of ETFs that yield something between 7.5% and 8.5% in your world, like fixed income world.
Yep.
It's a pretty big world.
Yep.
Right. But the credit metrics and the risks that you can take on for, you know, that range of, you know, what you think is going to be your return is epic. Yes. Like it's really, really interesting, like to see that people have put a lot of capital into. Like when you said 30 billion now?
Yeah, in the aggregate, it's like 29 billion in CLO ETFs.
Yeah, on its own, HYG is like.
And the first one was created after COVID. So October 2020 is when the first CLO ETF was created. We had been observing this because we knew we're large players on the institutional side, and we thought, okay, this is a great way for us to bring access to what we're doing.
Yeah.
But just think about that growth. Like HYG is probably 16 billion. I think BKLN and SRLN, which are the larger loan ETFs, are south of 10 billion. This is an asset class that has quickly taken off. I do think it has a tailwinds of the fact that it's floating rate.
Yep.
And you had the Fed accelerating, you know, really people can take advantage of that. But it's an asset class that it continues to expand. And by the way, if you look under the holders, it can be retail or individual, but there's institutional clients that are also investing in ETFs because you might have a large pension fund that has a liquid fixed income book that they manage in-house. and they can either be strategic or tactical, and they choose to maybe do that in the format of an ETF.
Yeah.
So it's been incredible growth.
Yeah, and just the ability, I think it's going to do, this is just my top-down, like the future according to me, I'm from the future, right? But why wouldn't you do it the way that I just did it? Like, why would you be beholden to these legacy fixed income ETFs? If I thought a better decision with my capital when we went from Quad 4, I sold I was long both. I was long HYG, I was long a bunch of stuff going into Quad 4 because you should have been. Between October and January was a rip.
Yeah.
For anything equity, anything high yield credit was a great moment, period in investing time. If you make the decision to get out in Quad 4 for me, which was in February, you're like downshifting CLOZ, eventually got out of it, took it all out, and HYG, et cetera, took out all my credit exposure, everything that I could. But the first thing I came back to, I could have bought HYG. Why would I buy HYG when it has, first of all, the differential in yield on its own, and take on the rates risk? I mean, I wouldn't do that.
Yeah.
But prior to these types of introductions, I would have to think about doing that because I wouldn't have anywhere else to go.
The asset class just wasn't ready for ETFs probably until the past 5 years because of the liquidity. Like, people weren't ready for it,
right.
But it's been tested and it's been incredible. Actually, one of the other ETF issuers, I was listening to a podcast that they were on, and they said they had observed the LDI crisis that happened leading up to October 2020. And what happened in the UK is basically they needed to raise liquidity. And guess what they did to raise liquidity? They sold AAA and AA CLOs because it was the least mark down position in the portfolio, and it was the most liquid, and they knew they could get billions of capital raised very quickly. So this was all leading up to it's ready for the ETF wrapper. And I think now, you have choice. You used to not be able to pivot into
No,
CLOs.
not even close. I mean, and there are other CLO ETFs, obviously. So
yeah, of course. What I would say, if I want to talk about what's distinctly different about ours, is we have the AAA, which is CLO X. I like to think of that as extra protection. That is pure AAA, tier 1, the most liquid managers. We really want it to be what you're using it for, which is that capital preservation play. We lead with that. And then CLOZ, which is CLOs, but trying to be cool. CLOZ is BBB, and that product, if you kind of look at the products suite right now, we were the first to really give true exposure to the BB. Mm-hmm. And the reason why we did that is we knew we could do it because of where we're positioned in the CLO market. We're active participants. We trade that product. We invest in it every day. But it's, again, tier 1.
Yep.
So we're aligning with the credit managers that are going to tend to that pool. They're also going to have the workout experience if there are any defaults. We want to make sure they have a seat at the table. So that can be 60, 40, 50, 50, BBB. That's going to be your highest risk-adjusted yielding CLO ETF because you have that BB.
Yep.
We'd rather have BB exposure with a tier 1 manager than 100% of a BBB where you're then having to reach maybe on manager or reach for spread. This is not a spread reaching product. It's a spread preservation product. We want high quality income. So we'll sacrifice, actually, we'll pass on a deal even if we can get paid more to take that risk because we really want to align with high quality.
Well, it's interesting too. I mean, we could talk forever about this. We're going to have to wrap up
I know.
soon. But I mean, it all starts with where's your starting point.
Right.
Okay, you've worked your butt off your whole life, or you're a family office whose family's before yours has, and your job is not to lose the money. There's a lot of different ways to start the conversation, but really, what is our primary goal?
Yes.
And not everyone, sadly, starts with Charlie Munger's rule number 1, which is don't lose the money.
I know.
Right? Don't lose money, preserve and protect the capital. I like to say preserve and protect the pile, compound returns on the pile. Yeah. If you start with that, what's actually happened in ETFs is that the whole thing is bass-ackwards. Is that all the products that allow you to do what I would start with came after the first 2,500 ETFs that don't do that. They start with, hey, one of the most successful ETFs, which you guys are well aware of, in the history of self-directed investing for family offices, individuals alike, is Cathie Wood's ARC ETF.
I know.
Right?
Yeah.
Because that's the opposite of what I just said.
Right.
Which is, I want to start with taking on, I want the juice.
Right.
And there's nothing wrong with that.
I know.
In fact, when we're going into quad 2, I want juice.
Right.
Like, I mean, my version of juice in your world is CLOZ.
I was like, it's still very conservative.
But it's really, I find it dynamic and interesting, and it's going to be ever changing, because I really do think that there's an opportunity to start people, get back on your front foot. Don't just start with like, you'll hear people say, hey, look, I only invest what I can lose.
Well, I mean, then you're really taking bets, right?
Right.
And nobody wants to be doing that. And again, we're coming out of what used to be ZIRP, so people didn't even think of credit as being cool, right?
Yeah.
They didn't have this compounding. I mean, the institutions were doing it.
If CLOZ, I hear you what you said, like the Z is like to be cool, but it's not. Like,
I did think about this. Like I lost sleep over this one night because we were going down the path of tickering it in a different way, and I was like, CLOs with a Z.
In what world CLOs will eventually be cool? I do not know.
Never.
I don't know if I want to be in that world. Like, it would have to actually be a pretty dark world, because everything that's cool currently is very uncool.
I know.
But that tends to happen pretty quickly.
I mean, we'll see. It's I try to make it cool, but it is so not cool. But it's fun to talk about.
Yeah.
Because I love unpacking that it's not what people think it is.
Yeah.
And I think that's what we're supposed to do, right? In educating and advocating and talking about a product, and then just making sure people understand what the risks are too.
Yeah.
Right? At the end of the day, you don't want to think of things single dimensional. It has to be, you kind of have to take it all into account, and that's what we're doing today, right?
Yep.
We're talking about a product that is often misunderstood or miscalculated, and the data's there.
Yeah.
But you, like what you said, you can use it. Like you can pivot in and out, and that's what's great about we're giving people choice by having the different products.
I mean, it's really easy to be misunderstood in a world where you don't have an opportunity to educate people on what that is.
Right.
Especially in a world like newsflash, and this is going to probably insult some of our clients, but I really don't start with that either. I mean, what you're introducing and educating people on here is absolute and direct competition to everything that already has all the AUM.
Right.
And they're not going to be, I'm pretty sure I'm not going to see a commercial from HYG on why you should think that CLOZ is cool. That's not going to happen ever. And that's another thing. Like there's all self-interest associated with the current things that people own, duh. And there's opportunity in what people don't currently own, and we can only educate them on that.
I think it all starts and ends with education, because people are going to get into situations like a 2022, and then they're going to call up their financial advisors and say, wait, I thought that the fixed income part of my portfolio was going to hedge against the equity portion of my portfolio, and the increased correlation, and everything's down, and you're going to have to answer to that. You're going to have solutions on how that maybe that is coming back into favor now, but this access point, or this democratization, whatever people want to call it, of having more choice now, whether it's through the ETF wrapper or other wrappers, is just better for the investor. And I think the future investors, like the generations behind us, are really going more towards like a self-directed, where they want to learn and they want to have choice. And that could be in partnership with a financial advisor, but you're starting to have people are going to challenge and say, well, what else is there? Or what are other people doing? Or and I think that's a good conversation to have. And this is just part of that.
And that's why I got the front runner was I'm so excited for this conversation, because people are excited actually for new ways to think about it.
Okay, thank you.
And
Whoever
you do
said
make
that.
She makes it about as exciting as you can make it. Like, I mean, really. So thanks for making the time to be here in person.
Oh, it was so good to see you, Keith. I had so much fun, and thank you for having me on.
Well, we're going to have to bring you back.
Okay, anytime.
She's the only person who can make CLOs cool. All right, so thanks for joining us. If you have any questions, compliments for Danielle, of course, you can post those on Twitter. But we're around. Thanks for joining us.